Somebody knew the resize a cell. That's the one Excel macro or one Excel shortcut that I need to learn. Size a cell to the text width. If anybody knows that one, that's an elite one. A phase 3 PREVAIL trial. Yeah, it looks like a pretty good drug. HOI, is that it? Abraxane. That's an old school one. That's so awesome. HOI. I'll try to remember that one. Gotta love sustainability highlights. Man, only sustainability I care about is cash flow. Sustainability. 𝗏𝗄𝗏 out at FDA since when? That'd be very concerning. That's Elon's favorite word. Concerning. Everything he says is just a variation of concerning. Highly concerning. Not concerning. Concerning. Somewhat concerning. He's like if Star Trek came to real life. All right. Well, 𝗏𝗏's out. That means... Does that mean Replimune getting approved? See, this is where Godel kind of shines. I could do 𝗏𝗏. I don't see anything yet. Oh, wait. I should probably clear all these filters. Reset to default. 𝗏𝗏. No, still not out on the wires. Probably will be. Vinay Prasad pushing his ass out. Oh, he's retiring. Okay. That's not, big deal. He'll be working at Pfizer soon. Or AstraZeneca, for that matter. I like AstraZeneca. He was pretty friendly to drug companies, but this allows Replimune to get approved. Oh, INQ's dropped. Net debt, 23,965. That's in US dollars. I love AstraZeneca reporting in USD instead of pounds. That's kind of based. GBP, pounds $1.31 versus the dollar. So this is 13,780. That's in pence. This times this divided by 100 to get back to pounds. Multiply by 1 million to get back. And there's the AstraZeneca USD market cap. Should be 283 billion. Let's actually see what it says on the ADR. Yeah, 280. So that's about right. 283, 284. Let's get the debt in there as well. 123, 123. Okay, so it's 300 billion enterprise value, which puts it, very, very one of the largest companies in the world by far. As big as UNH. Let's put in some earnings. See if this backfires. It backfired. So AstraZeneca's 19 times 2026. We'll do some more forecasts in a second. See how we feel about that given the earnings growth. The street, of course, always forecasting some. I think Pascal said his ambition was to get to 80 billion in revenue. I think if I was not mistaken. So about 5 times sales. Revenue growth. The street's forecasting 5 or 6% revenue growth. Not that heroic. I think he said, it's in the model somewhere here. 2030, he wants 80 billion. That's his ambition. The street's at 77. I'm at 54, of course. Not including any new drugs yet, really. So I'll have to see what the pipeline will bring. But at least with the current portfolio, that's kind of what you get. I have put in some numbers here for other drugs. Not too much, though. Obviously, if they hit 80, it's very cheap. And one of the ways you can think about this, I mean, this is basic finance, but this might help you. One of the ways you can think about this, and I hope somebody clips this because I'll teach you some basics here. AstraZeneca is going to make 918, 1014, 1115, or 1150, 1268, 1406, and let me get the 2030 number. 1526. Okay, let's assume this is true. This is like the finance I taught dudes in jail. Let's assume this is true. Okay, these are the years you're running a business. Doesn't matter what you're making, pills, software, widgets, doesn't matter. But this is the earnings that we're going to see. This is pretty good. 10%, 14, 10, 11, 9. So after what, 5-6 years, you're getting 66% growth in earnings from 2025. So that's a pretty robust growing business. Okay. We know that the street likes to pay 20 times the earnings. Why do they pay that? Well, that's a different lesson. But they like to pay 20 times earnings. Okay. So What's the stock price now? Well, let's check. $90.61. Now, an ADR of AstraZeneca is worth two per share, for what it's worth, and they have a little net debt, but they pay 20 times earnings for the local share, and the ADR is 2x. You get half a share, so you have to cut it in half. Anyway, so basically, you know, for the ADR, it's all 20 times earnings. So right now it's, you know, $90, but if the earnings are going to grow like this, why won't people pay $152.60 right now for these earnings? 20 times earnings. Well, in 2030, they're going to pay, if this comes true, which we're going to assume, they're paying 153. They're going to pay 153 in 2030. How does that help you now? What does that mean? How do you think about that? Right? Imagine you close your eyes, you rip and Van Winkle, you wake up, and in 2030, the earnings per share is $15. You went to sleep when it was $9. Now the earnings per share is $20.30 and it's $15. And the stock is trading for 153. That listing doesn't matter. There's a few ways to look at this. Well, you say if I hold from then to now, I will generate an 11% return. That's one way to look at it. And you say, is that good? Is that bad? Well, what's the risk-free return? Well, that's just the 10-year yield, right? What's the 10-year yield? Anybody know off the top of your head? It's like 4.1%. Let's just assume it's 20 times earnings. That's what the market's paying now. They may pay less in the future. They pay more in the future. Not our concern. So this is the risk-free rate. This is our return. How about the AAA bonds? What are those yielding? Anybody know? AAA is 5.3. There you go. Meme knows. How do you know, Meme? How about BBB or B? You need to also adjust for, you make sure it's the right duration. So that's 6%. And how about some junk? I mean, is that junk? I think that's junk, right? Sounds like junk is more like 7. Okay. And what have equities kind of returned over the last 10 years? Should we do that one? Maybe let's do a couple of them. How about that? So let's see, 5-year return on equities. Let's take today's price. And then, I don't know, let's take, let's 1 year, 2, 3, 4, 5, 37.60, 2 minus 1. So this was an 82% return over 5 years, but we have to do rate. 5 years minus this, that. So that's 13%. So if we keep going as we've gone for the last 5 years, that's actually not a great return, the 11% return. We could do better if we just bought a generic stock, but is that the best way to look at it? Well, let's see, 2134, if we do the same math, that's over 10 years. The return's going to drop a little bit to 12%. It's been a really good decade for stocks, my man. Let's go to 15 years. Yeah, market's very overvalued. Still 12%. And let's go to 20 years. Let's get to, this is what starts to make it a little ugly. 9%. Now that 11% doesn't look so bad. It's a pharma company, so it's probably a little safer than your average stock, right? But let's keep going. Why not? This is fun, right? 2000 was 15, 52.87. Uh-oh. That sounds not so good. 25-year return on stocks. How are we treating dividends here? Does it matter? It does matter, of course. 6.1%. So versus 6.1%, that sounds great. And we're not done with this lesson. It's going to be very interesting, but let's do a couple more interesting here. If you go back to 1995, market's gone up 10x since then, but it also has been 30 years. That's 8.3%. So I'm going to do 20, 30, and this is 5, 10, 15. This is 35 years. The market's almost gone up 20 some odd percent. And again, this doesn't mean that the future market's going to do this, right? Why is the US so special? Well, you know, we've had a great run, but is it going to be like this forever? Well, it depends on how many Lena Khans and AOCs we get. We get more Lena Khans, AOCs, and Elizabeth Warrens. So over 40 years, that's done great. But this is meaningless. What I'm doing right here, it's worthless. It's garbage. Who cares? Why? Why does it matter? Well, let's do this. Let's look at the Nikkei. Nikkei, please, as my friends say. Okay. The Nikkei is the Japanese stock market. And it's right now at 49,000. But now let's look at in the same framework, and you might be a little more concerning, very concerning. So these are the returns. So Japanese stocks, so US stocks are anywhere from 6.1, 6 to 13%. Let's write that down. US stocks. That sounds pretty good. It's like, I'll take my chances, you know. Any old stock, I don't need to look at Astra Zeneca, who cares? Any old stock would do the trick, but hold on, what if we were like Japan? And remember, keep this in mind, Japan sort of was like the number 2 economy. So that's like, you know, it's not like, okay, maybe what happens if we're, you know, not number 1? You know, it'll be very interesting to see how this works. So literally 1% return was possible. Over 35 years, Japanese stocks returned 1%. 35 years, 1% to today. Can you imagine? That's worse than Stanfield Capital. So don't assume the market's going to help you. We have to be vigilant. We've had as much as a 12% return over the last 5 years. So you get some pockets of strength that look good and some that don't. Now, what if we did, you know, a country like France? What do you think? How we do in France? Should we pick something else? Let's try France. They have a stock market, or the index is called CAC there. I know a lot of you guys like CAC. Some of you really like it. All right, let's do the math for that. So here you had 1 to 6%. I'm going to make a tweet about this. It's going to be fun. Oh, I should have done Chinese stocks too. Anyway, point is, these are some returns you can expect. So 11% sounds pretty good. Now you're making a few assumptions. One, the market will pay 20 times earnings in 2030. So could you make another assumption? Is there another way to look at this? I think there is. One of the ways you could look at it is say, what's the present value? Well, if you say my cost of capital is this risk-free rate, and we'll explain why in a second, but let's say it is my cost of capital is this risk-free rate. It's 5 years from now, and I'm going to have $152 in 5 years. What's that worth today? Well, that's worth 124 today. And that's a 36% upside. So the market's missing something that potentially could be worth that much. But your risk-free rate and the risk-free rate the market's using are different. The market might say, well, this isn't as safe as a bond. It's a company, right? Is it as safe as a AAA bond? Well, in that case, the upside's less. Well, is it as safe as a BAA bond? Well, the upside's even less then. And is it as safe as a junk bond or a portfolio of junk bonds? Well, if you value it compared to junk bonds, which are almost equity-like, I mean, you don't get much security in a junk bond, it's still kind of cheap. But if you start to look at it as, well, what's my upside if that rate is more like a stock rate? You know, I assume we're going to make 8%, which again seems like a faulty assumption. Markets have gone up kind of 8 or 9% a year, but they're not guaranteeing to go up 8 or 9% a year. So this, to some extent, is guaranteeing you an 11% return. Again, what if multiples go down? Well, then you're really cooked, because if multiples go down, let's say even to 18%, 18 times. Well, now, even if they do this 66% increase in earnings, that means they're making 66% more 5 years from now than they're making today. That's a lot. If you told me you're going to make your business is going to grow by 60, 70% over 5 years, almost doubling the size of your already huge business. It's already one of the biggest businesses in the world. But the market says, instead of paying 20 times the earnings, I'll pay 18 times the earnings. Not much of a change. Multiples the standard deviation of multiples is very high. Now, it could also be higher, arguably, but you know, all that has to change is little, maybe not even one standard deviation change in multiple. And now you have only a negative 3% compounded return over 5 years. Now, the returns may start again, but what if AstraZeneca goes into a lull, right? What if the earnings actually start to drop? Thank you. And, you know, the CEO retires, and it turns out that, you know, the earnings don't go up 10 or 11% every year again. They only go up 1% a year. And the market says, well, I'll still pay 18 times, but with such a low earnings increase, you know, in 2035, just 10 years away, again, we're still going to hold it at 9% discount rate, you'd make far more money not buying the stock, even though all things considered, I mean, this is not a bad growth trajectory. 10%, 14%, 10%, 11, 9, 1, 1, 1, 1, 1. This is kind of the slow period where maybe they fire their CEO or whatever. But earnings are still growing. They're never declining, which is, you know, not a bad achievement. Even with that slow period, you're still growing. But if you could get a 9% return somewhere else with the same amount of risk, you actually would have lost money on a comparative basis. Now, of course, your share price is still going to go up. It's just going to go up somewhat anemically. What's my rate of return that way? Well, you just do equals rate, 10 years, minus this, positive that, and I see a 5% rate of return. Well, we look at our little handy sheet here and we see that's equivalent to buying AAA bonds. Well, AAA bonds are going to give you that payment. Those are bonds of the highest tier corporate companies or corporations like Apple and so forth, and Astra Zeneca. You know, and you won't have any risk. You are the senior bondholder to those companies. If those companies do well, it doesn't matter. If those companies do poorly, it doesn't matter. They're going to pay you one way or another. And if they don't, well, you get to own the whole company. So you don't want that. But, you know, AAAs have never defaulted really. So, you know, you can basically sleep at night, never even think about stock prices. Whereas the stock price of AstraZeneca is going to gyrate quite a bit. These bonds are so secure, so much more safe. You know, why would you buy this when, you know, you're better off just buying AAA bonds? And I think that every time you think about the market, you should think about this kind of stuff. Now, this is macro stuff, but at the same time, you know, it's still important to think about what am I buying when I'm buying AstraZeneca? You know, I'm buying a very good CEO, who's probably not going to live forever. I know that. As good as he is, he's not going to live forever. Somebody who takes over may suck. That new person that takes over. And this is why management is so important to so many investors. Management takes over, they're bad. And this is like, it's not even bad. This is kind of more of a, well, it's sort of bad. It's more mediocre. Let me do more mediocre. 3% return. It's still like a really bad decision. You could make that same return buying bonds. So now if you know markets are going to go down a lot, this isn't such a bad idea because you could have negative returns for some period of time. That has happened many times. So anyway, I just want you guys to sort of see the way I look sometimes at conceptualizing what is an equity. We haven't talked about that in a while. Like why would I buy this? What am I buying? And I'm buying, you know, a share of a company for 19 times earnings that, you know, is going to grow earnings pretty well. And in 4 or 5 years, probably could give me a good return, but what am I foregoing by investing in other things? So sort of a basic finance lesson, but a little bit more, you know, applied to stocks in particular. I'm definitely going to get a lot of actually. Okay, I'm going to call back my buddy. I just looked at index prices. What do you mean? Just waiting on CAPR watch. All right, 𝗥𝗎𝗀. It's forever, man. Just 𝗥𝗎𝗀 cash flows between now and expiry is like 40 billion. Awesome, Almond. Hopefully CAPR after the bell. That'd be good. If you get me that salmon salad, sure. Takes heart cells and tries to IV them into patients. Spoiler alert. It's cap. It's all cap. Yeah, 𝐀𝐦𝐞𝐫𝐢𝐜. Huge disappointment. I think I have a deviated septum. Zoladex ever going generic? I don't think so. TrueCap is not cap. It's a really funny name. TrueCap. Some Zoomer name this thing? We're going to call it cap. We're going to call it true. True cap. I'm editing the wrong column. What options did I buy? I'm short the stock. I try not to buy options. Only bad things happen when you buy options. Sometimes I buy puts. These people really want your hand held. Short a little of the stock. That's all you got to do, bud. Don't overthink it. With call protection, no. Look at the calls. How would you make money? There's no way to make money that way. There's literally no return. I shorted some options yesterday. Try not to buy options unless the vol is really favorable. And the vol here is a little out of control. Can't think it's going to be a hypertension drug that does it. I know Street's thinking this could be a big product, but I don't think so. Oral PCSK9. Pazer's retiring, so. All right, let's see what the AstraZeneca pipeline looks like. They got camizestrant, ceralasertib. Pretty sure that's a nothing. 𝗬𝗓𝗪𝗔𝗬𝗑𝗫. Is that, it might not even be their drug. No, it is. Okay, ATR kinase. Yeah, I thought they killed this thing. Oleclumab, CD73, another kind of dead target. 𝗥𝗖𝗓𝗔𝗥𝗧𝗜𝗢𝗔, 𝗓𝗡𝗔𝗠. Okay. There's a PD-1 CTLA bispecific that, let's see what this one is. That's dead too. Okay, this is a TIGIT bispecific. So that's dead. That's why we're on CAPR watch. 𝗕𝗢𝗓𝗡𝗦, 𝗓𝗡𝗔𝗥. Kind of Me Too drugs here. Or like slight, you know, not Me Too, but like slight updates, slight improvements. Yeah, that AstraZeneca oncology pipeline's not too exciting. KRAS G12D armored TCRT. Is armored? Is it armored? And I'm definitely not spelling armored with a U. Yes, I like spruce. Steep 1, steep 2, just steep. Abilities on, I don't think there's a probability, right? I mean, they have FDA approval coming up. Iraq is kind of a dead target. We didn't, Ian, but I think it's this week. I don't think we're waiting much longer. She said Q4 as well. I went back. I don't think there's any way this thing slips to January. But, you know, it's biotech. You know, anything could happen. Sorry, Habibi. Go get a job at Starbucks, bud. Because it's over for you. She also said coming weeks. They're really investing in STEEP 2 as a new prostate cancer thing. That's probably correct. I'll just stay short then. I mean, if... Thoughts on spruce? I like it. I don't think you should have your full portfolio in it if that's what you're asking. Oh, do you have your full portfolio in it? Oh. Did you buy it at the exact top? Oof. Okay, so oncology pipeline's kind of blah. STEEP is the main thing there. Maybe STEEP could be a few billion or more. 𝗍𝗓𝗓. This is the exciting thing. Oral PCSK9 in phase 3. Laroprovstat. Yeah, I'll visit Albania at some point. You top tick, you get the top tick XLC. I have no comment on that, Clark. I don't know that drug, sorry. Atobemetinib. How is this a small molecule if it's antisense? Oh, is it APOL? Ah, there's their GLP. Okay, so they're gonna do, you got GLP. Oh, they got oral. Tozorakimab. IL-33. Phase 3 for lower respiratory tract disease? What? Okay, they got COPD, asthma. No, COPD. And then respiratory tract disease. It's bronchitis? Oh, they got asthma too. Okay. 8630. Oh, they got inhaled. That's partnered. 7798. Maybe they'll buy AstraZeneca could buy Abivax. That'd be a good deal. Astra needs a pipeline. Should I make the calls? Make it happen? Okay, they got the Iraq inhibitor. They got 2 different Iraq inhibitors. Inhaled Jack. Didn't somebody try this? Moderna has a lot of cash, doesn't it? Flap inhibitor. What's a flap inhibitor? Oh, I remember this molecule mechanism. Okay, so I don't know. A lot of credit being given to Astra management here. I don't see too many drugs that get me that excited. Baxdrostat being a big drug is kind of a LARP. STEEP I can believe, but oral PCSK9 is kind of meh. Which one of these is going to be that exciting? They already have a lot of debt, so I don't know how much more they could take on. I don't know. This stock has run a lot. They've done a really good job. Depends on your position. Don't tell him what he can't retire. Don't hurt his dreams. He might retire.